For the first time ever, Wall Street's name has vanished from Canadian dollar bonds. Not a single U.S. bank was involved in Ontario's recent $2 billion bond sale or Alberta's massive $4 billion issuance. Sure, the financial machines are still humming along, but behind the screens on Bay Street, warning lights are flashing. The half-century-old financial bridge between Canada and the U.S. is beginning to crack, and European giants like London and Frankfurt are quickly stepping in to fill the gaps. As Canada's leaders push for deeper ties with Asia, tariffs from Washington are no longer just slicing through trade. They're now hitting the flow of money itself. Can global supply chains handle this sudden pivot, or is this the beginning of a fatal blow to the U.S. dollar's reign? Stick around to find out. Subscribe and hit the notification bell because this story could shake your wallet and the entire global market. It all came to a head in early June when Ontario floated a $2 billion 10-year U.S. dollar bond. The sale went smoothly and the bonds sold out fast, but something was missing. The familiar logos of American banks. In their place, Barclays, RBC, CIBC, and Scotiabank. No big celebration followed, just quiet handshakes, nervous glances, and the recognition of a stark new reality. The tariff fight with the U.S. had officially crossed into the financial battlefield. At first glance, it looked like a minor political flex, a momentary headline. But behind closed doors, the shockwaves rippled across Bay Street for days. After all, the bonds were still sold in U.S. dollars, and the deep liquidity pools that fuel these deals still sit across the Hudson River. Yet despite that, Canada is now building its own financial channels instead of waiting passively by the American money stream. By mid-March, Alberta had quietly removed Bank of America from its latest $4 billion Eurobond deal. High up on the 27th floor of Calgary Plaza, the Risk Committee leaned against the glass, watching sunlight dance across the snow-dusted mountain peaks. They had no choice but to bet that Europe would be ready to catch what the U.S. was letting fall. This new euro-denominated window sent a clear signal. Risk across Canadian bond markets was being recalibrated. Almost immediately, banks tightened their collateral demands on BB-rated loans. Asset managers widened their hedging positions, with swap desks zeroing in on the euro-dollar spread. But this wasn't just a shift on spreadsheets. It was beginning to ripple into personal routines. A lady, a pension fund manager in Edmonton, quietly scrubbed her Washington trips from the calendar. Her usual quarterly check-ins were now happening over lunch in Frankfurt with European regulators. Meanwhile, a swap broker in London barely flinched when a Toronto-based client requested to swap US dollars for British pounds. What once seemed unusual was now routine. The mood on the ground had settled into something more stagnant than surprising. Beneath the surface, credit markets were starting to tremble, prompting Ottawa to discreetly fast-track new export strategies. Old market files, long shelved at Export Development Canada, were suddenly being dusted off. Green logistics lines stretching towards Southeast Asia were updated. Land plots near Brazil's Santos port were flagged as priority storage zones. At Montreal's logistics fair, an unexpected wave of Vietnamese brokers showed up, all keen to learn how to streamline Canada's freight insurance without touching US-backed guarantees. And while all this unfolded, unease was quietly brewing in Washington. Canadian bond commissions had always been a quiet but lucrative niche for Wall Street. When they're lost, the front pages don't scream, but the pain is still felt. But by the time December's premium tables were published, the missing margins hit like salt in an open wound. When senior figures at JP Morgan found themselves unable to secure Canadian lines in the new bond schedule, a quiet but pointed question from an insurance broker echoed down the trading floors. If you pull out a small stone, will the whole wall crumble? Ontario's restrictions didn't just stop at the bond desks. In late April, the province quietly inserted a crucial clause into its procurement rules. U.S. suppliers would no longer be eligible for government contracts unless Canadian or allied alternatives were available. This subtle regulatory tweak forced every public tender, from steel bolts to IT services, to source locally first, then from friendly nations, and only as a last resort from the U.S. One state hospital procuring manager paused when a bid for IT services arrived from Sweden instead of Seattle. It felt unusual at first, but after factoring in currency shifts, the Scandinavian offer actually turned out to be more cost-effective. Meanwhile, the real ripple effects were being felt in the deeper layers of the currency markets. The Canadian dollar initially took a hit in the first week of the tariff standoff, but quickly found support as Brent oil prices climbed. Still, Ontario and Alberta's slow retreat from U.S.-led bond syndications applied a subtle but meaningful technical pressure on the USD-CAD exchange rate. Banks, sensing a shift, began padding their overnight liquidity buffers. A Vancouver-based commodity trader summed it up plainly. It's just a little harder to find U.S. dollars after 6 p.m. now than it used to be. It was the first time in decades since the 1998 Asian financial crisis that traders had to pencil in such liquidity restrictions for the Canadian dollar. A small crack had appeared in the wall, but the tremors were beginning to spread. The shift in how Canadian companies assessed risk wasn't just a defensive move, it opened doors for local businesses. Take, for example, a mid-sized solar panel assembler in Thunder Bay. Thanks to the extra tariffs slapped on Chinese-made panels, their market share at home nearly doubled. But as much as protectionist policies provided a boost, supply chains remained stubbornly global. When copper coil shipments from Shanghai were delayed by 3 weeks, production lines in Thunder Bay ground to a halt on an ordinary Tuesday. Inventory costs piled up, financing pressures mounted, and suddenly those hard-won domestic gains seemed far more fragile than they first appeared. Out west, Alberta was pushing in a very different direction. The province began eyeing new oil loading ports along the Gulf, sketching out tanker routes that would connect the Pacific to Asia. It wasn't just about moving oil, it was about reshaping Canada's export map. These new routes allowed Alberta to dream of financing a slice of its dollar demand outside the grip of U.S. banks, leaning instead on European insurance networks. Using the Brent oil benchmark provided a natural cushion for the Canadian dollar's parity. But the game got complicated when pipeline protests flared. As the political risk climbed, European investors, especially those focused on sustainable finance, started pulling back from projects that clashed with their green investment mandates. In this strategic chessboard of global finance, the U.S. still holds its trump card. Even though the White House is signaling a slow return to calmer trade relations post-Trump, the looming threat of trade barriers and tax penalties still shapes every serious conversation around cross-border capital. For Canada's risk managers, there's no turning back to the old ways. Even if tariffs are lifted tomorrow, total dependence on the U.S. won't return. Diversification is no longer just a contingency plan, it's a permanent fixture in corporate strategy binders. On the swap desks, models increasingly track the European Central Bank's curve, not the Fed's. The axis of financial gravity is shifting, and Canada is moving with it. When London custodians quietly began opening sub-accounts for Canadian portfolios, it became clear this wasn't just a detour, it was a deliberate new course. Yes, the capital ties between Canada and the U.S. remain enormous. By the close of 2023, U.S. investments in Canada were nearing $500 billion, while Canadian funds held nearly $1 trillion in U.S. assets. But here's the catch. Capital flows don't react instantly to political noise. They move like mountains, steady, slow, but not immune to influence. The base is solid, but the upper layers, now warmed by tariffs, new procurement barriers, and shifting loyalties, are carrying the risk of an avalanche. Analysts agree that the deep financial integration is too complex to sever completely. Still, even a small bump in the risk premium can ripple through the system, shortening bond horizons and raising the cost of financial guarantees. The signs are already here. A Montreal-based insulation manufacturer chose to relocate its planned Ohio factory to Saskatchewan, not because of tariffs, but because the terms of U.S. financing suddenly felt less predictable. On that same day, a Boston asset manager didn't sell off their Canadian provincial bonds, they did quietly hedge against a 5-year trade war scenario. As winter's ice glazed over the skyline of Bay Street, the streets below began to freeze. Beneath this frosted surface, a new financial map is starting to emerge, one marked by London banks, Frankfurt brokers, Singapore swap desks, and Tokyo institutions, each leaving subtle but lasting imprints on Canada's monetary landscape. Call it a quiet rebellion or a strategic safety net. Either way, the lines are now firmly drawn. Canada's financial dance with its southern neighbor will continue, but the rhythm has changed. It's louder, faster, and increasingly driven by other players. And as Bay Street awakens to this new tempo, one question lingers in the minds of analysts. Can Canada adapt to this multi-layered rhythm, or will the country and the global partners tied to it struggle to breathe under the weight of these icy financial shifts? Only time will tell. As new financial arteries stretch from the Singapore dollar to the British pound, from oil to rare earth minerals, everyone is watching for signs of pressure, waiting to see where the first blockage might appear, whether in the granite towers of Toronto or the oil pipelines of Calgary. Because finance, much like water, always finds a path. It seeps through the cracks, carving out new routes, unless, of course, the ice locks it in, where the pressure bursts the system entirely. What's your take on this unfolding story? Share your thoughts in the comments. And if you don't want to miss our next deep dive, hit that subscribe button and turn on the notification bell. Thanks for watching.